This is Pull Request Hotfix. Short and sweet and hard to beat. Pull Request Hotfix is a quick shot of tech news, diving into one highly relevant topic each episode, with 4 techno experts. Eric Newman, Ryan Cwynar, Stephen Jude, and featuring Tyler Dinner. Today's episode, DeFi 2.0, Decentralized Finance. Hello, everybody. Welcome to yet another Pull Request Hot Fix. My name is Eric Newman, and across from me, in person, for the first time in I don't know how long, is, I have to say, you know what? I think we have to do a very hard transition because we need somebody to bring him in, if it works. That's right, the drummer to the show is back after a long tour of the West Indies, the Philippines, and somewhere else that has no internet connectivity. Tyler Dinner! Woo! What the hell have you been doing?
Fighting myself.
You've been fighting yourself?
Yeah.
Yeah, you have been fighting us. Well, it's nice to have you back. Welcome back.
It's good to be back.
Thank you.
Thanks for welcoming me back.
That's right.
I'm the prodigal son.
Yes, that's right. And someone who's done a much better job of replacing you is the person that I've done the last few hot fixes with, Ryan Cwynar. Hi, Ryan. How you doing?
Hey, doing good.
Nice to hear from you again. And where are you?
Oh, now I'm in Coral Springs. I actually just got back from I did a trip down to Key West over the weekend.
How was that?
It's pretty fun. That's pretty fun. I don't
think I've been to Key West in like 20 years, 15 years.
This is probably my best experience of it, actually, so far. So this is pretty good.
What made it the best?
I van lifed it. I van lifed it with the girlfriend and stuff. So we were running around there doing things. It's pretty good.
Oh, nice. Yeah, we need to start the van life series. But before we get more onto that, let's welcome a new guest to the show, Stephen Jude. Hello, Mr. Jude. How are you?
I'm good. How are you?
I am. Don't ask that question. I'm wonderful. I guess that's the best way to put it without saving. We could do a whole podcast about how I've been. And what do you do, and how do you know Ryan?
So Ryan and I go way back, about, 13, 14 years now? We were actually...
Yeah, by definition, it's at least 10.
At least 10. At least.
Air Force Academy?
Yeah, we were roommates at the Air Force Academy sophomore year, and surprisingly have kept in touch since then.
Wow, Ryan and I went to high school together, and we've still managed to keep in touch. It's great when friends keep in touch for long periods of time. You get to watch them grow older and slowly start losing their hair. And
what was the joke we were making? We were looking at like some photo or something the other day, and I was looking at a photo of Eric, and I was like, "Hey man, you look like a tired version of who you were in high school."
Yeah, the rest of you looks the same, but your face just looks really tired. And the same thing goes for you, Ryan.
Use a nap. Yeah, I'm
like John Mulaney joke. Who's that tired child with the yellow teeth? So. Well, welcome, Stephen, and we have you because Ryan alluded to you last time on our last hot fix about DeFi, Decentralized Finance, and you actually have a lot to say about it. So before we get into the new stuff, why don't we quickly recap what we talked about last time, even though all of the listeners that we have can just listen to the last episode. We talked about MakerDAO, which is what, Ryan?
MakerDAO is a decentralized autonomous organization whose main benefit is to capture some of the functions that a central bank provides by giving us a stable currency, but without a government and without any of the centralization or corruption that comes with.
Again, you used central bank while describing a decentralized entity. That's something that kind of gives me a headache.
It's the mechanical benefits of a central bank captured in like a contract, captured in a smart contract, so that you can maintain a stable currency, and then you have a way for people to, in mass, govern the function of that contract, so that you can decide on interest rates and stuff, so that we can have stable ways to transact and leverage our assets.
This sounds like it sounds like high-frequency trading and that type of algorithmic analysis of habits and currency transfer, but used for just regular monetary transfers. Does that sound right?
Well, I don't know. At this point, I mean, I've learned... So Steve told me about Ethereum like 6, 7, 8 months before I was I got into it, and when I first heard about it, I was like, I don't know, man. I think I'm more excited about renting out these vans than thinking about the world computer. And then and then lately, now that I'm like, I've been steeped in crypto stuff for a couple of years, and then now Steve is calling me. He's like, "Hey, man, I'm getting really pumped about this DeFi stuff," and I'm like, "I don't know, man. I don't know if I'm excited." And then I caught myself, and I'm like, "Wait a minute. I should probably get excited about this DeFi stuff."
Yes, and I have such a chip on my shoulder over cryptocurrency because the Bitcoin boat sailed up to my dock in 2012 and said, "Hey, Eric, you want to come on?" And I said, "No, that's all right. I'll stay here." And then they come back a year ago as a giant yacht, and I'm like, "What happened, guys?" And they said, "We had a great time. Where have you been?"
Yep.
So
Missing the boat, literally.
I literally missed the boat, or metaphorically missed the boat.
Not when they got boats, then it's literal.
That's true. Anyway, and then Tyler, how are you doing with the whole cryptocurrency stuff and watching it go by? Or
Yeah, I bought $200 worth when it was super high, and I'm stupid.
no, it's
Now this DeFi thing sounds sweet.
Yeah.
as long as we don't blow it.
Well, I mean, what Ryan described sounds pretty cool because to me it sounds like a centralized bank, but that's not backed by an army.
It's not centralized, and it's not backed by. It's not backed by an army. It's backed by an equation. And actually, I think this is probably the logical point at which we get Steve's variant on explaining this, because I think he's had it stewing in his mind for much longer than me.
So, Steve,
sure.
why don't you tell us about the beautiful stew of DeFi that you've got?
Yeah, sure. So I'll probably focus on MakerDAO, since that's probably the most famous or well-known application right now.
Sure, and that's what we were just talking about, so that's a good transition.
Yeah, because DeFi in and of itself probably refers to like a wide variety of different platforms, but
Absolutely.
yeah. So MakerDAO. So as we're all aware, like Ether and Bitcoin are pretty volatile, and so spending it is very, I guess, probably unpalatable to most people, just due to the volatility of the price. Because who wants to spend 10,000 Bitcoins on, a pizza? And then one day realize that they spent multi-millions of dollars on some pizza. Probably.
It's almost like people buying the island of Manhattan for $20.
Yeah, exactly.
Or whatever it was. Anyway.
Yeah, so
Go
It was
on,
a
please.
good deal.
So if you wanted to essentially take out a loan against the currency that you have, the cryptocurrency you have, you could do so with Maker. You deposit your crypto and you get out an asset that's stable. It's not going to change price.
So it could be any coin, any altcoin, even like just anything that you can turn into.
As of right now, it's just Ether, but
Okay, just
that's going to change here November 18th. But it's essentially a way to take out loan against your own assets without selling it. So
it's like a pawn.
no, because you're not selling it.
Well, the pawn is a temporary. You give your asset to the place, to the pawn shop. They hold it until you repay the value that they give you for the pawn plus interest.
Yeah, essentially. Mm-hmm.
So it's like a pawn, but digitally.
Yeah.
Look, I have not watched all 10 seasons of Pawn Stars for nothing. Okay, so anyway, I don't want to detract.
You're not getting that time back, Eric.
I'm not, but you know what? You're looking like a possum eating pink sticks. Let me tell you what. You could have talked that lady down another $1,000. What you doing, Rick? I'm sorry, that guy's dead. I loved him so much. Anyway.
Why do I hang out with you?
So MakerDAO, first time back, you realized every reason why you left.
This is why.
All right.
Here it is.
So Maker and MakerDAO essentially allow you to create a quote unquote pawning system, kind of with Ethereum right now, Ether, and it creates a stable security. Could you call it a security?
No, it's not a security, but
What would you call it?
I just call it a stable coin. It's
Okay.
pegged to the U.S. dollar.
That's pegged to the U.S. dollar. So how does that get around the whole central bankness? Because my biggest gripe about a lot of these cryptocurrencies is when they get pegged to the dollar, they lose that decentralization. They lose that ability to really have that type of real autonomy that I believe a lot of the cryptocurrency movement was founded upon.
Kind of getting into pretty metaphysical aspects of this, but I mean, there's no central party that owns, I guess, the whole system, and so it's a way for people together as a network to basically take out loans against themselves and print a stable coin that's at the moment tracking the US dollar. So there's no central party that's responsible for this. So I don't know.
Okay.
I have some questions.
Sure.
Yeah, and I'm pretty bad at finance in general. I like to think so, but I'm pretty good at the rest of the world. I understand most stuff. So I don't understand the big benefit of this, and it sounds crazy, and it sounds like, well, not crazy, but it sounds like it's a lost game at some point because, say, Ether is worth $900 one day, and then I have that, and I only paid $50 for it because I got it when it was cheap. So then I'm like, oh, okay, I'm going to take out $900 worth of loans, and I'm going to get cash against it. But then the bank, right, the centralized bank gives $900 to me, but then I can repay that loan if it goes back down to $50, and I can repay it all. Does it work like that?
No, not quite like that. So the way it works is when you deposit ETH, you can print DAI, which is the stable US dollar coin, and you have to maintain a certain level of collateralization to the amount of DAI that you take out. So as it is right now, you need to have at least 150% collateral to the DAI loan that you have taken out. So
And that collateral is represented in other coins, other cryptocurrency, or just more Ether, I guess?
right now
It
it's
is
just
ETH,
Ether.
yeah.
So say, for example, you deposit $150 of Ether, you can take out a loan of 100 DAI. And if the price of Ether drops to now your loan is under collateralized, i.e. it's less than 150%, then the system is going to liquidate part of your collateral to pay back the debt in order to get your collateralization back up to 150%.
And that
This
happens
is-
completely autonomously.
Yep.
Yeah.
Okay.
This is a part of it that I read that what this ends up doing in practice is that people will not just over collateralize. They'll kind of like hyper collateralize to where, in order to make sure that they don't run afoul of that mechanism, people will put in 3 to 4 times the collateral of whatever they intend to borrow against.
But doesn't that create some kind of artificial stability in the market?
No, it's real stability. It's as if people were just, being
Well,
responsible.
they're doing it out of fear, I guess.
Kind of, but it's still creating a real form of stability from people just sort of like using their judgment. Like if everyone owned property and then whenever you needed to make a financial move, you took like a home equity loan at a rate of like 5 to 10% the value of your house, like there's very little danger of that economy ever really running into trouble because no one's over leveraging or everything is very like safe and responsible. Like you have an abundance of assets backing up your liquid financial activity.
Interesting. So how exactly is DAI pegged to the dollar?
So it's all based off of market mechanisms. So the main way.
So does this go back to what I said about it's like high frequency trading, but on the currency level instead of the stock level? Then
No, high frequency trading is a way to arbitrage inefficiencies between different markets, and you do it using computers that have an advantage based off of speed. This is done, I guess, in human time, so it's not like high frequency type scale of time, but the primary way
is it a slower way of doing the same thing?
I guess. I mean, high frequency trading is a very specific technique for trading stock markets, but with DAI, the primary way, there's a couple ways it's pegged the dollar. So if you go to a market and you see that DAI is selling for like $1.02, then there's some sort of discrepancy there, right? So people can arbitrage the market anytime DAI kind of breaks its peg. So if DAI is above $1, then you can go to Maker, mint more DAI, and then sell it on the market for that 2% difference. So,
and is that something that you would have to do manually, like with you watching it, or is that something that
you could create bots to do this? Right?
Oh, okay.
And then if DAI is less than $1, then all you have to do is, if you have a loan out, you can pay back your loan on the cheap, right? So if it's 98 cents, then essentially you just paid back your loan for a 2% discount. So that's kind of like the primary way that DAI is pegged to US dollar. And the secondary way is there's these different parameters that the people that govern the system can change. So right.
And who governs this?
So it's governed by, it's called MakerDAO, DAO being a decentralized autonomous organization. Yep. Which, as a quick tangent, and by the way, I still own quicktangent.com, I used that last week accidentally instead of database abstraction object, which is the joke that I made the first time. And I was like, oh, someone said DAO, and I was like, oh yeah, the decentralized autonomous organization. No, wait, no, it is a database abstraction. Anyway. Someone's laughing at that. All right, so go on, Stephen. So the other mechanism kind of used by the MakerDAO system is to change the interest rate on the loans. So when you take out a loan, it's not a fixed rate, it's a variable rate. And so the MakerDAO can change the rate at which loans are given if the market needs it. So, for example, if too many people are taking out loans and flooding the system with more DAI, thus kind of decreasing the price of DAI and breaking the peg, they can increase the interest rate on the loans to kind of incentivize people to pay back their loans and decrease the amount of DAI that's out in the system.
Oh, that's interesting. I actually didn't know. I knew about the target feedback, target rate feedback mechanism, which is essentially the 2 cents up, 2 cents down mechanism. But I wasn't exactly sure how the interest rate thing was doing it.
So if it gets too, so I guess interest rate is what they do to kind of massage that back into the proper peg margin that they wanted. That's interesting. And so is the game for this profitability, or is it just to create an interesting financial system?
Well, so it really solves a huge problem in crypto, and that goes back to the fact that no one wants to spend crypto because they're afraid of, they sell crypto and either one, they've got some sort of capital gains tax that they have to pay, or two, that they've sold an asset that's going to go 10x in 2 years and lost out on that gain. So you can take out a loan with assets you own and never have to sell your Ether. And the byproduct of that is DAI, which totally benefits the entire system because you mint DAI, you send it out into the world, and anyone can buy DAI and use it. And now you have a US dollar equivalent cryptocurrency that is inherent to the system. So it's
interesting.
I get it.
Yeah.
I get it. You buy a bunch of cheap coinage, right? And then it's like, oh, well, then I'll just get that $200 back that I spent on it. And then in 5 years, when that stuff's worth millions, then you just pay it back with your millions.
Oh, yeah, because then your collateral is worth way more because you still own your collateral. Yeah, that's kind of the idea.
Unless it goes outside of the bounds, and then they have to liquidate some of your collateral to make the margin.
Yeah,
but if you were running anywhere near the collateralization threshold, like if you're just playing with fire, you're just yeah.
And is the reason that it's pegged to the dollar just to limit the volatility?
I think it's just an easy thing to track.
Yeah, exactly. Most people are used to dollars. Dollars makes people comfortable. You could peg it to whatever you wanted, essentially. You could peg it to the price of Apple's stock if you want, but that doesn't really do anyone any benefit.
I've had a hard time not thinking about this part of it because I think it would be amazing to have a stable coin. I think the Libra thing actually kind of had the right idea where you would peg a stable coin to the value of a basket of goods, kind of like we already do. Like whenever we're measuring inflation or whatever, we tend to focus on like a basket of goods and compare like what these 10 things together cost now on average versus what they would have cost 10 years ago.
Right. But I feel like it's a similar setup to what caused the housing crisis 10 years ago. That's just my thinking, but I'm not.
Yeah, so you're thinking of derivatives and
but derivatives didn't start out as derivatives. They started out as a basket of goods, a basket of mortgages. And then
what happened
as a security, right?
And then
the
with
securities
that,
then got repackaged as derivatives from the securities, so it became abstracted a level.
Yeah,
that's kind of the. Yeah. I was going to say that the danger of it was that they made bad mathematical assumptions about what constituted diversification of risk, and so because these things that on paper were AAA low risk loans, but in fact, if you were more mathematical, if you were more inclined, and in fact, I can't remember the name of the guy in The Big Short that kind of was calling it. Or yeah, Steve. No, that was one of them. But there was the guy that Christian Bale played.
Oh yeah,
that guy. That guy was like calling it, and he was saying like, these are actually bad loans. And then he came face to face with the corruption in the financial system, where like, you should lower these should not be rated as AAA grade debt. These should be junk bonds, basically. These should be junk debt.
And that essentially goes back to, I guess, human error. And if you take humans out of it and make it more algorithmic based, then
So the issue with the whole Great Recession was the fact that people were taking side bets on these markets, and when you're betting and gambling on the markets via the form of collateralized debt obligations, which is essentially, they're just gambles. They're not like, people don't have any skin in the game with CDOs, right? They're just betting on the price of the underlying securities. But with something like Maker or any of these DeFi projects, like, you can go to the blockchain and you can see the fact that the system as of right now is over collateralized by 323%, right? So your faith in the peg of DAI can be pretty strong, because there's 3 times the amount of ETH locked up to that in that contract than the value of DAI that's currently in circulation. So it's pretty transparent, and I mean, I guess that's one huge benefit of this whole system, is that you can go to the blockchain and you can see, what's there and what's not there.
Now, how can you prevent a single person, a whale, if you will, from kind of strong-arming this market and taking it astray based off of a couple of transactions in large volumes?
Well, I'm not quite sure in what mechanism.
Someone dumps in a ton of Ethereum, Ether, whatever you want to call it, and then wait a couple of weeks and then they take it all out. If that was responsible for the over collateralization of the market, and then they just take it out, then that kind of...
When you make a loan, you're making a loan out against yourself. So the only person you're able to hurt is yourself. The system as a whole is limited to how much Ether that can be deposited. Well, it's not...
Oh, yeah?
Well, I wouldn't say that. I'd say there's a limit to how much DAI can be printed. So there's a...
And is that an arbitrary limit like Bitcoin?
It's it's somewhat arbitrary, but it's set at a level to basically guard against liquidity risk for Ether. So the thinking there is, you don't want so much DAI printed that you couldn't sell off the ETH without crashing the price of Ether, right? So if you had like half of the market cap of Ether in DAI printed, if Ether's price were to drop, it would just crash the whole system. So if you keep the debt ceiling pretty low, which I think right now it's like 100 million or something, then Ether's price can crash, but DAI will be fine.
And that's why it's a stable coin.
Yeah, which is what we saw in 2018, because they actually released and opened Maker late 2017 at the peak, and DAI survived the entire crash all the way down to like $80-something.
Wow. That's actually pretty cool.
Yeah, that kept its peg it was interesting because it's the first kind of massively successful DeFi project, as I understand it, that really before this, to get a stable coin, the mechanisms for making a dollar pegged like a tether or something were pretty dubious. But this is the first time that it's basically an equation, and it just works, and it worked in good times and bad, and anyone can see how it functions if they're so inclined.
Interesting. So how can we prevent or protect against abuse of this type of thing? It sounds really cool until it starts getting messed with by people that have, profiteering or malicious interests.
I'm actually not, even theoretically, I guess it would take, I'm not aware of any obvious mechanisms, but I mean, people that are trying to get creative with manipulating markets or making a profit tend to be, they tend to have pretty good gotchas that, the world hasn't seen before. But yeah, off the top of my head, I certainly am not aware of any obvious linchpins or Achilles heels to go after this type of mechanism.
So,
okay, Stephen, how about you?
I think you'd find that most people would say that the weakest point of any of these systems is the price oracles. So in order to...
The what? I'm sorry?
The price oracles. So for...
The price oracles. Okay.
Yeah. In order for the system to work, you need to have some way to feed the price in to the contracts so that you know when something is under collateralized or not.
The price of what exactly? The price of Ethereum or the price of the dollar?
Ether. Yeah, primarily. So whatever your collateral is, you need to figure out some way to get the price of Ether into the system. And so that requires some sort of trust mechanism. And right now, Maker's got this pretty advanced Oracle system that they use to try and reduce the risk of someone gaming the price. Because that would be one way to break the system, right, is to say Ether is, half of what it is and cause the whole system to crash. But so as it is right now, Maker's got a pretty elaborate Oracle system that we can go into if you want, but I'm not the complete expert on it. Essentially, the big picture is they take a whole bunch of different feeds that are anonymous, and there is economic incentive for these oracles to give the correct price, and then they kind of average out the prices that they get from the oracles to try and detect any outliers or bad prices, I guess.
And what's the economic advantage of the oracles giving a good price or the right price?
So I don't know because there's not a whole lot of transparency on that part, but this whole system is going to change anyways when multi-collateral DAI comes out. So
and okay, well, why don't we talk about that really quickly?
Yes,
multi-collateral DAI is just, I guess, different types of collateral. So not just Ether, but any other coin.
Right. Exactly. Yeah. So you could have Ether, and then I think one of the ones that they're looking at is the basic attention token, and a couple other well-known tokens to be available for MCD.
Oh, that's great! So, because then you could just take that stuff that the Brave browser gives you, which nobody Brave, right or not, or Braves?
Yep, mm-hmm, Brave.
Nobody Braves.
Brave. The Braves is another service. The Brave browser gives you for watching ads and actually turn it into something.
Yeah,
which
that would be cool.
I really think the basic attention token, I really think is the precursor to the new social media economy that's coming. That's probably a whole different topic. That's
a whole other hotfix. But okay, well, this sounds really cool. So the DAI debt ceiling, Stephen, you wrote, is 80 million DAI backed by 500 million Ether, and also backed by 650 million MKR, which is the Maker token.
Yeah. So when I took those notes, that was the price was somewhat different. So right now we got 840 or no. 84 million DAI out there. Maker itself, I don't know what its market cap is. And then
it was like $500-ish, $600-ish last I saw it.
Yeah, but that note goes to an aspect of Maker that we haven't talked about, which is the MKR token. So,
and what is
that?
The
MKR token serves a couple of purposes. The first purpose is it's how governance is done for the system. So in order to vote on different parameters, such as the stability fee, aka the interest rate for the system, you need to have Maker tokens in order to vote.
And is that just like an intermediate token?
It is. I don't know what you mean by intermediate token, but it is.
It's the other side of the market, I think, is the way to say it. Is that more accurate? Like, so you have DAI as the stable coin that is being minted and repaid, and then is Maker part of the mechanism for accepting interest and voting on the interest rate?
Yeah, so it allows you. It's like the key. Okay. It's like the key that allows you to vote on the system, but it is also an essential part of the whole DAI system. And I think Ryan was alluding to it. When you take out a loan, that interest rate, so however long you have the loan out for, you have to pay back the loan plus the interest. Well, that interest goes towards buying up Maker and burning it, i.e. reducing the supply. So the thought there is if the system is good and it works, people will take out loans and pay back their loans. Then
it'll equalize out.
Then MKR will the total supply will get reduced through this burning mechanism, and thus the people that hold it can expect the price of their token to go up. So
is that like a bond, I guess? Or no?
It's more like shares.
It's like like a discounted price flow kind of. You can price it in a way where like you have an expected flow of cash coming in the form of people paying back their loans, and so you can kind of predict out based off of the loans and outstanding interest that's due. You'd be like, well, I know this much Maker is going to get burned, and thus you can kind of predict the supply of Maker. And so
and then queue up transactions to buy or sell based off of that, which leads me to go back to my high frequency trading analogy. I feel like in principle it's the same thing, at least on that level. I mean, it seems to be a little slower than high frequency trading right now, but it's a smaller ecosystem that's operating at a slower rate, but you have these signals that are coming in. You have projections that are created by these algorithms to determine the signals going out that then influence the value of these monetary devices.
I can see the analogy with the mechanism that you're making, but I think the character of it and the speed of it and the reasons for why high frequency trading is like that versus how this works and why it is how it is doesn't hold.
I look at high frequency trading as a technique for people to take advantage of inefficiencies in the market.
So but high frequency
it's like a
trading,
loophole, right? And then this is like a new stability that we're adding to the market.
But high frequency trading came about just because of the scale of the market itself and the amount of people trying to just get a little edge over somebody else.
Yeah, but this isn't that.
HFT is like it's an equipment arms race almost. It was literally like whoever can get their trading machines physically closer to the exchange with a higher bandwidth, with a better algorithm.
And they're trying to cut the tops off of mountains, and I get that. To create a line of sight between New York and Chicago. But, okay. Well,
the thing being optimized is very different.
I'll retire that analogy then. Okay, so we have this MKR token that is essentially created when people mint DAO. Or DAI, sorry, when people mint DAI. Is that correct?
No, MKR was kind of established at the beginning of the Maker system, so there's like 1 million total in existence, and there won't be any more printed. Unless the only way Maker gets printed is if the system needs to essentially create collateral to back DAI. So we talked about how each loan needs to be collateralized by 150% of ETH at the moment. Well, if that loan like drops too low and now that loan can't get paid back, something needs to take that underwater loan and make it whole again. And the only way to do that would be through printing more Maker and selling that on the market to clean out that debt. So that's the other
quantitative easing?
Sorry?
Is that like quantitative easing?
I guess in a way, all it does is it dilutes the supply of Maker, thus reducing the price, right? So the system is incentivized to have good governance, because if you have bad governance, then the system will fail and Maker will need to be printed in order to pay off bad loans. Whereas if the system works properly, then the loans will get paid off, that interest will go towards burning Maker, and the supply will be reduced, thus potentially increasing the price of Maker.
Interesting.
Yeah. So
interesting.
It's a form of governance that incorporates some pretty cool economic incentives.
How do we prevent people from these central banks from getting in and kind of mucking with the system? Or do you think that it just like generally it's just tight enough algorithmically that it can't happen?
Well,
I'm a big fan of the dog coyote analogy that I make a lot, kind of around questions like this, where like I really feel like governments, banks, large corporations trying to play in the crypto space is sort of like someone who wanted a dog that substituted it for a coyote and then was surprised when it tore apart their couch. Or them.
That was an episode of Baskets, actually. But that's another story. So you don't think it's that really... that's not going to happen, you don't think?
I guess if someone was really... Like, if they really hated the system, they could go out and buy up a whole huge supply of Maker tokens and then vote for bad features of the system and then just totally crash the system. But that's like a lot of work and money for no return. So,
do you think that would be a lot of work and money for someone like Goldman Sachs?
No, but I don't think they have any interest in doing so.
You sure?
I mean, this is like small potatoes to them. Like,
if it becomes something actually substantial. I mean, they've also mentioned that they wanted to get involved with cryptocurrency. They did right before the crash last year.
And they'll make their own market.
Yeah.
Well, right now they're making the Apple credit card, which is doing well for them. But I just feel like that's if this becomes too successful, a central bank, or they're not a central bank, but they're a giant bank, would try to dismantle it.
I suppose, but I think as it is right now, like Maker the token is held by a small number of people / organizations.
And who are these people? Is it Satoshi Nakamoto one of them?
No, it's I don't know their names off the top of my head. There's
or just who are they with? Are they just people just out there in the ether?
They're just people.
Pun intended.
Yeah, they're just people.
Oh. There's people. So, like, the president of Goldman Sachs could be one of those people.
It could be.
I'm not trying to rain on your parade, Stephen. I'm just trying to see how this could be exploited for monetary profit, because it goes back to what I had mentioned earlier about my biggest gripe with cryptocurrencies when they get pegged to fiat currency like this one is. But I understand the reason for doing that is to limit the volatility and to make it easier to track. But, I mean, that's what... technically all these stocks with high-frequency trading are pegged to the dollar.
Yeah, but I think if you're going to...
And market caps and debt ceilings and stuff like that.
If you're going to attack the crypto system, I don't think Maker would be the way to do so.
What would you do?
There's lower-hanging fruit, I would say.
Yeah, there's probably lower-hanging fruit in the form of some of these exchanges that live on the internet that don't have any insight into... how their trades get done and whether or not there's wash trading or nefarious.
What's wash trading?
So wash trading is essentially when you're like trading against yourself to manipulate the price.
Ah.
Great. I think the exchanges have actually been the biggest the biggest moving target for seeding distrust or slowing down the rate of adoption or like damaging the reputation of the crypto markets and making them be perceived as more vulnerable than they are. I mean, because in essence, if you hold a good cold storage wallet and you're holding cryptocurrencies, and there's very few ways for you to be exploited or have those coins taken away that are technical and not more akin to like social engineering.
Well, the coins wouldn't be taken away per se, but the value that they represent could disappear.
Yeah, I mean, in certain, by damaging the reputation of a market, that's the primary way to do it. But I think exchanges are a much lower hanging fruit of exploitation fruit.
This is just, and these transactions are just person to person, peer to peer, so you don't really need an exchange, which I guess limits the, right, or no?
Yeah, technically you don't really need an exchange at all. Like, I think most exchanges could just be done with smart contracts, and then as long as people knew where those contracts lived, you could get all that stuff done. It just, like, these exchanges essentially had been created because they create liquidity and they make, it's a better human interface, but technically all this stuff could be done through much more secure mechanisms with that's an odd topic, and I really think it's been a perversion of the intent of the cryptocurrency space. Like, it's like when you get involved with like any kind of marketing thing. Like, all of a sudden you get on the internet and you start studying marketing, and you end up in seeing all these programs where people are selling marketing to marketers and selling how to market to marketers, and like the exchange markets, it's like people are selling coins for coins, and they're selling coins to people. It's just coins. It's a very like it's like an inbreeding or something that's happening within the markets.
There's not a multi-level marketing scheme to create more exchanges yet.
Yeah, so the real magic is gonna come from when we use this stuff to drive real commerce. Like, not, like the cryptocurrencies are supposed to be the infrastructure. It's supposed to be the sidewalks and the sewage systems or whatever. It's not supposed to be the store that you go to make the profit. Like, the profit should come from the great businesses and systems that you've created on top of this infrastructure. You shouldn't just be marveling at sidewalks, which is, I guess, kind of akin to what the hype around the cryptocurrency markets has been just far. People are going, oh my God, there's a road here. There's a road here. How do I get rich off of roads? And like, it's like, there hasn't been as much focus on how do I make a mechanism that innovates on business models that have just never existed before, which is really going to be the magic. When we get new ways of making micropayments, or new ways of executing complex financial instruments and escrow and managing assets that are more efficient, require fewer middlemen. That's going to be where the real magic and efficiencies and tide raising and breaking down some of the barriers that states create and the ability to enforce contracts.
Yeah, so that's actually a pretty cool point, and maybe this would be an interesting way to kind of maybe wrap up the discussion a little bit.
Sure.
So MakerDAO, as far as I know, they're working with a couple of interesting partners, and one example of low-hanging fruit that you can use the Maker system for would be trade finance. So real quick description of that. Say you're like a supplier that you sell some part or good, and you sell it to like a big company like Walmart or some bigger company like Lockheed that takes that smaller part and then uses it for their product or service. Companies like that typically work off of invoicing, right? And so they create an invoice for their product or good, and then maybe a month or two later that invoice actually gets paid. Well, that month or two time difference between creating the invoice and getting the cash can be pretty hairy time for some companies if they're cash strapped.
Sure.
So there's ways out there right now to go out and like essentially get.
You could factor invoices and stuff like that.
Yeah, you sell your invoice on 75 cents on the dollar, and then you get the cash flow that you need at the time you need it, but you lose out on that 25 cents on the dollar for that invoice that you had. So it's a pretty bad system because it can lend itself to some pretty predatory practices. So, for example, if you're like downstream of that supplier and you know that this company is cash strapped, well, you can just not pay them and then cause them to go bankrupt. And then you go to turn around and you buy the company and you've just essentially acquired a company on the cheap. So one way around this is there's a company, I think they're called TradeShift, where they're essentially going to be like the middleman between Maker and some of these companies. And what they'll do is they will tokenize your invoice. They will print DAI against your invoice and give you the cash that you need and do it on a lot cheaper.
So it's essentially like invoice factoring with DAI.
Yeah. So you can.
Oh.
This company will be the middleman. They'll take the risk, and then they will print DAI as needed to service these companies with cash when they need it. And they'll do it a lot cheaper because you don't have to deal with a bank, right? And you don't have to go and have some sort of credit score and relationship with a bank because there's no people that you're interacting with. It's just Maker.
Right, until China opens up that social credit score API. Says your Q rating isn't high enough to take out this loan. So, no, this is great. I'd love to talk about this again whenever we can. The world of decentralized finance and cryptocurrency really is. I'm so happy to be. I mean, as millennials, it's like we really think nothing is new. Everything has been done, and this is it's a new world of finance that is trying to be corrupted by the old world of finance, and hopefully this one isn't. So, why don't... Sorry?
Oh, sorry. I was going to say, I really do hope that crypto is a coyote and not a dog that the banks can't take home and domesticate easily. That's really like an analogy that I make, but also just sort of a hope. I just hope they just aren't able to domesticate it.
Yeah. All right. Well, why don't we end it there? So, Stephen, you've been quite a fantastic resource. You have an open invitation to come back anytime you like, and we'll send a microphone out to you if you like, if you really do want to come back. And Ryan, a pleasure as always. Tyler, it's nice to see you in the flesh again.
Always fun.
I
Good times.
can see that. So why don't we all hit merge? And we'll see you next time for the next pull request Hotfix shortly. And we'll also, I promise, we'll do a real pull request, a full one, as Tyler's slowly leaving my apartment as I'm talking. Because that's how done we are. Thank you, everybody. So have a great night. This has been a Pneumonium production. The views and opinions expressed on pull request do not necessarily reflect those of Pneumonium LLC or its subsidiaries.